Welcome to the MUFG Global Markets Podcast. I'm John Cook. I'm joined today by Takahiro Sekido, Chief Japan Strategist for MUFG. It's Monday, January 9th, 2023. Welcome back to the podcast, Sekido-san, and Happy New Year.
Happy New Year too. Good to be back.
Yeah, it's good to have you. And it's been quite a break, both in terms of the amount of time. I don't think we've done an episode for a couple weeks, given all the holidays as of late. And it's also been quite a break in terms of maybe break isn't the right word because it was so eventful, but markets have been pretty crazy, particularly for what is typically a quiet holiday period. So as you know, as our listeners know, the Bank of Japan shocked markets, shocked investors with their surprise decision to unexpectedly widen the bands of its yield curve control policy. Huge surprise to the market. Why don't we start at the beginning? Why don't we start with you telling our listeners exactly what the BoJ did and perhaps why they did it?
Okay. Yeah, surprisingly, the BoJ, the Bank of Japan expanded its yield curve control operations range from 25 basis point to 50 basis point while leaving the policy rate at minus 0.1% and the target 10-year JGB yield at around zero. And also increase the amount of its JGB purchases to 9 trillion yen from 7.3 trillion yen per month at the December 19th to 20th Monetary Policy Board meeting. The BoJ decision came as a surprise to market participants. This is probably because policy issues out of the unified local elections had shifted to the balance to inflation from monetary accommodation. We think this is why the BoJ began to lose yield curve control operations at its own pace, different from the timing of other G10 countries. The BoJ has begun to make yen yield control operations more flexible before the end of current Governor Haruhiko Kuroda's term and make changes to JGB buying in terms of, firstly, range of JGB buying sums, and second, frequency. Also, third, schedule. We think the BoJ will ultimately return to its general green-bound style operations rather than unlimited fixed-rate JGB buying operations, and focus on stabilizing prices and a financial system.
Okay, so inflation everywhere across the globe has caused central banks to pivot, and it looks like the Bank of Japan is no different, although the timing is materially different than other G10 central banks, as you point out. I would also add that the yield curve control policy has been changed before. It was originally plus or minus 10 basis points, then it was plus or minus 20, now and then plus or minus 25, now plus or minus 50. So this is really an evolution of yield curve control policy, and every tweak has actually been arguably more hawkish or less dovish. So I would just sort of add that as context for our listeners. As a follow-up to that, why don't we talk about the market reaction and what we should be expecting from this new variation of yield curve control?
Japan's monetary base expanded to 632 trillion yen in December. The BoJ decided to raise its ceiling for the 10-year yield under yield curve control operations and increase JGB purchases, allowing the 10-year JGB yield to approach 0.5%. The BoJ's decision was a surprise, and the yen rate rose, but the BoJ managed monetary operations in line with this policy decision with increased purchases, causing the monetary base to grow. On December 29th, the BoJ announced that pooled collateral operations will be held on January 4th, 1 trillion yen at 0% interest on January 5th to 6th. Over the near term, we expect the BoJ to keep buying JGBs in line with its December decision. And we think, firstly, JGB purchases, Second, JGB lending. And a third, pooled collateral operations will become increasingly critical tools of monetary operations as the monetary base expands in line with the 0.5% yield curve control operation ceiling and the BoJ's overshooting style of commitment.
That's interesting. So I think everyone, or maybe not everyone, but it's relatively easy to follow the purchases, but don't forget about their lending as well as these pooled collateral operations. So
Yes.
point to take away from our listeners there. And again, we could spend hours literally talking about this, but to sort of I don't know, to compartmentalize, if you will. But I think the next logical step is on the follow. What's your outlook for the market, specifically yen rate? Let's start there. The Bank of Japan and monetary policy more broadly.
Okay. Yen rates rose in December after the BoJ surprise, particularly the belly of JGB yield curve. We have revised our outlook for yen rates to reflect the release of the magma debt built up during the monetary easing and the low interest rates of Abenomics, as our rising yen rate scenario occurred half a year earlier than we expected. We expect focus to grow on the outlook for BoJ's monetary policy over the near term once the BoJ leadership nominees are proposed after the ordinary diet session convened on January 23rd. Media reports emerged on December 28th that Hirohide Yamaguchi, who served as a deputy governor under former Governor Masaki Shirakawa, could be nominated as the next head of the central bank. We think that any nominee will likely have experience as a deputy governor, including former deputy governor Hiroshi Nakaso and current deputy governor Masayoshi Amamiya. That said, we think it is likely that the BoJ will make changes to the monetary easing put in place under Abenomics. Despite facing the political risk for the ruling Liberal Democratic Party (LDP), support for Prime Minister Fumio Kishida's administration falters ahead of the unified local elections in April. Since elections are not national level, we expect the Kishida administration to advance more hawkish economic and monetary policy in line with Kishida's new type of capitalism initiative, totally different from Abenomics monetary accommodations. We think the BoJ and the Japanese government could tweak their joint statement under the new central bank leadership, not only in regards to the inflation target, but also to cover green economic transition bonds known as GXJGBs and climate change countermeasures. In practical terms, we think that the climate change countermeasure operations could result in changes to incentive rates on current deposits at the BoJ and create yen repo arbitrage trading opportunities for the front end of the yen yield curve, possibly causing not only the long end, but also the front end of the curve to rise.
Yeah, so this is interesting. So I found, you made the point that, that despite, the administration's, low approval level, that they are clearly moving away from Abenomics and the policies that you expect to be put forward or gain traction are really going to be in line with Kishida's new type of capitalism. So, listener, take note. Things are changing in Japan, and some long-term or long-held assumptions, should certainly be re-examined. I guess is the way I would put it. So a lot of good stuff so far. Why don't we summarize it for our listeners? Simply put, what is your outlook for yen rate, spot dollar yen, and yen basis on the follow?
Yen traded as low as mid 129 level while the Tokyo market was closed for the extended New Year holidays. Before Fed hawkishness and U.S. employment indicators pointing to job tightness pushed the currency pair through the 132 before lower range growth and below the 50 reading on ISM services took it back into the range. The December CPI data will be the key over the near term. If the results point to inflation slowing, then the market speculation that the pace rate hikes will slow will likely dominate. Even if the Fed leadership doubts down the depths of its inflation fears, we expect the dollar yen to trade in a 3 yen range between 130 to 133 with a bearish bias replacing the neutral tone. Upward stresses on the yen swap rate curve has persisted, especially the belly. The Minister of Finance planned to hold an auction of 30-year JGBs on January 11th. The JGB yield curve is rising and a skewing in a 10-year zone stands out. We do not expect the upward stresses on the long end of the JGB yield curve to ease. The BoJ is nearing a sensitive period with a new leadership still undecided. The BoJ could buy even more JGBs if foreigner appetite for JGBs cools, but the BoJ probably wants to avoid any noticeable increase in JGB purchases before the new leadership takes place. We've seen an upward bias for yen rates, especially the super long end. We expect a 20-year JPY swap rate to reach near 1.3% for this quarter. The front end of the yen basis curve has tightened, while the long end has widened slightly. The yen basis has stayed in a tight range compared to yen rates. The Minister of Finance weekly securities data shows that the Japanese investors unloaded a net 26 billion yen of foreign securities in the week of December 18th to 24th, including 459 billion yen of medium to long-term foreign bonds and 84 billion yen of short-term foreign bonds, amid the 517 billion yen of net buying of foreign stocks and investment fund holdings. Foreigners unloaded a net 7.3 trillion yen of Japanese securities over the same week, including a net 4.8 trillion yen of medium to long-term yen bonds, 2.2 trillion yen of super short-term yen bonds, and 265 billion yen of Japanese stocks and investment fund holdings. Foreigners slashed their JGB holdings dramatically following the BoJ's December supplies announcement. While Japanese investors are unlikely return to JGBs soon, Japanese may not necessarily stop selling their foreign bonds. We see yen basis making a tightened bias.
Okay, so let me see if I have this straight. So you're bearish on dollar yen, although it sounds like you do expect it to be range bound. You have an upward bias to JPY rates, so you're negative on JGBs, and I think you said that your target for the end of this quarter on 20-year swap rate is at 130 basis points. That looks to be about 10 basis points higher than here, so sort of a sell off, but somewhat constrained. And then a tighter bias for the basis, which makes a lot of sense. As you say, foreigners sold a ton of Japanese government bonds up to this point, but sort of a lack of Japanese investor purchasing of foreign currency bonds and hedging, would certainly support a tighter basis there. Does that all sound right, Sekido-san?
Thank you.
Okay,
yeah, that's good.
Excellent. Well, hey, really great stuff. I mean, obviously, great, a ton to talk about here. We obviously will have more to talk about next week. But thanks again, as always, for coming on the podcast.
Yeah, thanks for having me and summarizing those concepts well, concisely. Well, thank you, John.
And thank you for listening to the MUFG Global Markets Podcast. Rate, review, and subscribe on Apple, Spotify, or wherever you get your podcasts. And reach out to your MUFG sales rep for any further information. Check back soon for more insights from the Global Markets Research Team.